So, what goes into net income? Well, for your primary elements of net income, which you're probably going to have some of every single period, there's four big classifications: your revenues and expenses. So, increases to income and decreases to income from things that are regular to your core operations every period. And then gains and losses, things that happen from time to time to companies in your field, but they're transitory in nature and they're not related to your core operations. So, selling investments, disposing of assets you have, recognizing sales discounts forfeited, paying interest expense. Those things are outside the core elements of your business, which your core elements would be making sales, paying to produce goods that you're going to sell, paying administration, advertising, etc. But you're going to have these four core elements on an income statement. When you report your expenses on your income statement, you have two different options for how you're going to report them. The first is the nature approach, which is classifying all of your expenses by the source. Where did they come from? Was it the cost of payroll? Was it the cost of raw materials used? Was it depreciation? You would have a bunch of different line items that represented the nature of where all of these costs came from. The other one is the functional one. So instead of reporting each element individually, you report them kind of grouped up by the core part of your business they came from: your manufacturing expenses, your selling expenses, and your administrative expenses. Which one is better? I like the functional approach myself because it just makes your income statement tidier and easier to look at. But you should, for the sake of comparability, go by what your industry does. You want your financial statement to look like your primary competitors so that users of information can freely compare your information to somebody else's. You also have an option when you make your income statement to use the multi-step format or the single-step format. And I think you can tell from my box around multi-step, it's just the better way to go. It reports several critical subtotals, components, measures of profitability you have that you can't get from a single step income statement. For example, a properly formatted multi step income statement would have all of these different measures of profitability reported in a clean, easy to read line item on your income statement: your gross profit, how much markup you made off of goods you sold, your operating income, your profitability after you've accounted for all of the core parts of your operation, your income before tax, which is your profitability when you've accounted for not just the core parts of your business, your operating income, but all of those gains and losses that you had during the period. Your income from continuing operations. That accounts for taxes in there, but it's just the income related to all the elements of your business that you plan to continue doing during the next period. Should you choose to discontinue part of your business, well, then you'd have to report your discontinued operations somewhere on here broken up. And after you account for your discontinued operations, it would give you your net income. So if you're a company that's going to continue everything, you wouldn't have a discontinued section, and your income from continuing operations and your net income would be exactly the same number. But if you have a component of your business that's no longer going to exist, you need to separate out how discontinuing that component of your business affected your profitability by reporting your income from continuing operations and ultimately your bottom line net income. And then lastly, at the bottom, you'll have your earnings. And earnings by themselves are kind of a hard number to measure in terms of how profitable you are for what you're working with. If you're a very big company, you're going to have a ton of people that bought into your company. You're going to have a bunch of shares outstanding. Having $100 million in profit for the year is amazing for a company that has, 1 million shares, because it's $100 million earned for every share that's outstanding. It's not as amazing for a company that has a billion shares. So to measure how profitable you are compared on the amount of capital you are working with to conduct operations, you're going to have your EPS, your earnings per share. And it is the only financial metric that GAAP requires as reported on financial statements. So you have to have this at the bottom of your income statement, no matter how you group expenses, no matter what presentation format, multi-step or single step that you use. You've got to report your EPS at the end because investors want to know not just what was your bottom line profitability, but namely, if I invested in your company, what amount of your income would I theoretically be entitled to for every share that I purchased? And that helps them compare you to your competitors. So here we've got a multi-step income statement. As you can see, there's a lot going on. It's big and it's tall and it's kind of hard to read because it's real small. Let's see if I can zoom here for you guys. There we go. So how are we going to start? Well, let's start at the bottom of this thing. We want to have our first measure of profitability, which is gross profit. How do you arrive at your gross profit? Well, it's just your sales revenue, net sales revenue, less the cost that you paid to manufacture those goods that you produce. So Papini Products over here with $234,800 in sales, spent $65,000 to manufacture them. Their markup, their profitability just above their manufacturing cost was 169,800. They are choosing to go with more of the um, nature approach here of each line item represented individually, but they are grouping them into the major subcategories of selling expenses. So their selling expenses and salaries and their advertising expense and their G&A expenses, they say general administrative costs, which is office supplies, office salaries, and depreciation on office equipment. These are still things they're going to do every period. They're still part of your core operations, so they should factor into operating income, and they do over here. As we can see, this company, which made $169,800 in markup off its products, turned around and spent $460,000, or sorry, $46,000 on selling costs, $45,000 on G&A costs, after they've accounted for all of the regular permanent costs of their operations. Papini Products operating income is 78,800. And then underneath that, they've got some elements over here which aren't core to their operations and might be transitory in nature. What are their others? Well, things outside their normal realm of what they do. These company manufactures and sells products. They're not an investment firm. So any revenue streams that they had from investments like interest income, dividend income, equity investment income, all those things would be others. They're outside of core operation. They also had a rather large gain on the disposal of plant assets, so they must have sold equipment or something along those lines. But all in all, their other revenues and gains increased their overall profitability by 42,200. They had a few items that decreased their profitability, which existed outside of their realm of normal operations. Interest expense goes in here, a loss on asset impairment, one of their assets lost value, so that they had to write it down during the period. And then they had a big old loss on an earthquake. So this company must have experienced an earthquake, which somehow damaged goods that they had or some of their facilities, and they had to pay to get that fixed. But all in all, things outside their core operations cost them $9,850. And if we take their operating income, increase it by their other revenues and gains, decrease it by their other expenses and losses, we get their income from continuing operations before they pay tax is 111,150. And this is a good point to talk about why this is my preferred statement because I have information between these two numbers that would be much harder to ascertain if this was just all lumped together into all here's all our increases and decreases to income. Their income from continuing operations before tax is way higher than their operating income. They're a company that manufactures and sells products. And for that, they had operating income of a little under 80 grand, which is perfectly fine and dandy. It's a number. But if you look down here for their investments, those three right there, they total up to almost 40,000, which means they had a huge increase to their income that came from something outside of making products. Maybe this was a particularly good period for the market that they're invested in. That's great. We're happy that they made more money. But that might not be sustainable in the same way that making and selling products would be. What if the market stinks next period? Well, all of this is not going to be nearly as good as you thought it was going to be. Maybe they won't be as profitable in the future. So, with these two different key KPIs, if you will, key performance indicators, you get a feel of what is really the quality of their earnings. It's not bad, but that is a big contribution to their overall profitability from others, if you will, instead of their core operations. But we were at their income from continuing operations before tax, $111,150. Well, we all got to pay taxes. We all hate it. They paid $33,650 in income tax expense, resulting in income from continuing operations of $77,500. So all of the things that they can reasonably expect to have happen next period leads to income of 77,500. I doubt that loss of earthquake is going to be there, but all in all, this is what we have from the elements of our business, which are going to continue. but they have a segment of their business that they know they're going to get rid of. And in that, they have to separate that out from their income. So over here, what do we have? I don't know what the segment did. Doesn't tell us in the slide. It doesn't matter. There's some component of their business they decided to get rid of. And two things happened from that component, which is being disposed of during the period. First, while it's being discontinued, it did operate during the period. And this was profitable, net of tax, for 12,500. So it increases their overall income. But since they're choosing to get rid of it, they're going to dispose of all of the assets. If this division had equipment or any intangibles that it needed to operate and they sold them, they apparently sold them at a loss, which they get to declare against their income. So the offset of the profit, the income that this discontinued segment brought in, and the loss incurred on the disposal of the assets related to this discontinued segment, the offset of those two is $2,700. So their net income is $2,700 higher than their income from continuing operations. This guy discontinued 100%. We know this isn't going to happen next period. So somebody looking at this could say, yeah, well, that was their net income, but I know they're not going to have this big chunk coming in from this thing they're getting rid of. So this is more of a number to make a prediction on what's going to happen next period. And then again, at the bottom, while it's $80,200 worth of income, is that good? Well, based on the size of our company, we can report our EPS, our earnings per share. And we're going to break it into two different components. The portion of that EPS that we had that came from continuing operations and the portion that came from discontinued operations. And all in all, our EPS was $2.01. All depends on how that compares to somebody else, but people looking at this information have a ton of stuff on here that they wouldn't have from a simple single step income statement.